Well, good afternoon. This is Betty Meredith, President of the Retirement Research Center, a retirement education and training company for financial professionals, their clients, and consumers. And I'm happy to be your host today for Introduction to Non-Qualified Stock Options with Dan Johnson of Principles Financial Consulting. Employees increasingly receive a significant portion of compensation in the form of non-qualified stock options, particularly in publicly traded companies. And many do not understand how NQSOs work, when income is triggered, how basis is established, and how exercise timing and methods affect taxes and portfolio risk. This leads to avoidable tax exposure, poor diversification, cash flow strain, and missed opportunities to align equity compensation with long-term financial goals such as retirement. And this webinar explains NQSO mechanics, taxation, exercise methods, timing, strategies, and tax management techniques so participants can make informed, repeatable decisions and integrate stock options into their broader financial planning. Dan is an advanced planning advisor at Focus Partners, a nationwide registered investment advisory firm. And in this role, he provides specialized consulting for advisors handling complex financial planning, tax, and estate taxes. He develops advanced planning resources and delivers firm-wide training presentations to enhance advisor capabilities. In addition to his consulting role, he is the founder of Principles Financial Consulting, where he offers specialized consulting to private advisors and develops educational webinars and content for financial education providers. He also serves as a part-time instructor at UCLA Extension, teaching tax, retirement, and estate planning courses to professionals pursuing CPA, IRS, EA, and CFP certifications. So Dan, thanks so much for being here with us today, and we'll now turn it over to you.
All right, well, thank you, Betty. I appreciate the warm introduction. It's a pleasure to be here today, everyone. I look forward to teaching you all the ins and outs about non-qualified stock options. So here's just kind of a review of what we're going to be covering today. We're going to first start off with the mechanics, going through the life cycle of a non-qualified stock option, helping you understand the underlying mechanics. We'll also then talk about when we sell it and how at this point it becomes a capital asset. We'll look at special tax situations such as supplemental withholding rates, how to adjust withholdings, net investment income tax, and things like that. We'll also look at how it's sourced at the state level because state taxes sometimes can crop up with these things. And then most importantly, we're going to go through how to maximize the value of these stock options and make sure that we get the most out of them and be able to use them for retirement purposes. And then from there, we'll look at a couple of unique little special scenarios. So at a high level, again, this is our agenda for today. We're going to go through the mechanics first, then we'll get into tax reporting, then some other tax issues. We'll go through the strategy section, talk about a few special scenarios, and then wrap up with some conclusions, takeaways, references. All right, so let's start off with the basic mechanics of non-qualified stock options. So I think the very first thing to understand is that a non-qualified stock option, and actually employee stock options in general, which can include incentive stock options as well, these are essentially a form of equity compensation being made to employees at a company. You typically see these with C Corps, for example. These are not like options that you would see on a secondary market exchange, like a put option or a call option. This is a different concept altogether. The other thing that I want to point out, and this is going to become relevant later on, is that options, essentially employee stock options, that is, give you the right to purchase employer stock at a predetermined price. And that's going to be in the equity compensation agreement that the participant gets. Now, this option, again, you don't actually own the underlying stock until you exercise the option. So this really represents paper wealth, but these can be worth quite a bit. So we want to make sure that we are very careful about when we exercise and how we exercise. So with that general preference out of the way, non-qualified stock options is going to be the more common of the two employee stock options. Again, you commonly see these with public companies, large C corporations. They are not tax advantaged like ISOs. So essentially, part of the option is going to be taxed at ordinary income rates, and then part of it's going to be taxed at long-term capital gains rates or short-term capital gains rates. Just depends on holding period, which we'll get into. Whereas incentive stock options, the entire thing potentially qualifies for long-term capital gain. However, unlike incentive stock options, non-qualified stock options do not have holding period requirements. Okay, so you can exercise and then subsequently sell the stock at any point after grant or exercise. They don't have any annual limits like ISOs, so these things are granted much more heavily compared to incentive stock options. In addition, the employer actually gets a tax deduction for these as well, whereas they generally do not with incentive stock options. So that's another reason why employers favor these. There's also no mandatory 10-year limit or accelerated vesting unless the employer requires this. And we'll talk about that a little bit later on when we get to special scenarios, like what happens if the executive were to leave. And also, we can transfer these to individuals or gift them away, but the W-2 income will still be reported back to us. And again, we'll cover those a little bit later on.